So we have a question that came in. Somebody wants to know what are the top three overlooked tax deductions for.
Top three overlooked tax deductions. Okay, number one is going to be an accountable plan. So an accountable plan it's under section 1.62-2 of the code. And what that is, if you've ever worked for a big company and you went to a trade show or something and you spent some personal money, you give your receipt to HR or whoever and they reimburse you, that's an accountable plan. It's a tax-free reimbursement for personal funds that were spent on business stuff. Tax or small business people really underutilize their potential expenses. And I know that sounds crazy because some people go way overboard, but most people actually go undershooting of the potential deductions that they could get. And it's because they're not properly tracking what's going on in their lives and what they're spending that could be attributed to a business expense. A quick example that most people are familiar with is the home office expenses. So if you're a Schedule C filer, there is a form, it's 8829, and basically you list out your square footage of your office and of your total house, and then you can apportion like mortgage interest and property taxes and rent and whatever else goes along with that. And it'll spit out a number and it'll say $1,300 is your home office deduction. So people are familiar with that. So the accountable plan can the home office along with a whole bunch of other stuff. So you might be using your car for work, for your business. You might be traveling for business. You might be buying internet for your house for business. So like in my house here, I've got a business plan and it's less used now because I was working out of the home office where I am now exclusively for about 5 years. But now we've got the new office that we've bought. All these kinds of things get included in accountable plans. And so that's number one overlooked deduction. Number two overlooked deduction, I would say, is the qualified business income deduction. The qualified business income deduction was created with the Trump tax reform back in 2017. And what it is a tax break on pass-through income. So your Schedule C businesses, your Schedule E real estate, your Schedule F if you have a farm, your partnerships, your S corporations, all of those are pass-through income. And you can get a break of up to 20% of whatever that income is. So if you have an S corp and the profit's $100,000, you might only pay tax on 80 of it, which is fantastic. And the more you make, the more that percentage is in absolute terms. And the more powerful it is because you're taking off the top, which means that you are taking off at the highest marginal rates that you might pay. So one, people are just generally unfamiliar with that, but also people have no idea how to actually plan for it. Because what happens is if you're underneath a threshold, depending on your filing status, whether you're single, head of household, married filing separate, or if you're married filing joint, there's two different thresholds for those categories. Joint is one and all the rest are another. And if you're underneath that, you can get a flat 20%. But if you're above that, then there's a comparison test, and it's 20% versus 50% of the wages versus 2.5% of the assets in the business. And that all gets super complicated super quickly. But it's an enormous tax deduction. 20% of your income could be huge. And we've had people who have six-figure qualified business income deductions because we plan for it and because we optimize for it. In some cases, that means paying yourself more on a salary because you get that 50% of wage comparison point. And sometimes it means optimizing the salary to be maybe less. It all depends on the situation. But that's a huge deduction factor. And then the third one, I would say there's a tie for third for a whole bunch of different things. My favorite personally is the Summit Strategy sessions. And what that is our take on what you might have heard of as like the Augusta Rule or the Master's Rule or something like that. Under Section 280 G2, 280A G2, there is a provision that was created in 1976, which just appears in the legislation one day, which is hilarious. But basically, if anybody rents out their primary dwelling for 14 days or less during the course of a year, then the income from that rental is not part of your taxable income. And so that's great. Anybody can rent out their place for any reason 14 times a year and not pay any taxes, just across the board. You could list it on VRBO, you could list it on Airbnb, you could just rent to a friend of yours for 2 weeks, whatever. That works fine. And that's an exclusion, which is great. But then in order to really supercharge it, you actually have your company rented from you. And as long as it's a distinct tax entity, so you can't work for a Schedule C business, as long as there's a distinct tax entity, like an S corp or something that has its own address, then that works. Now, there's a lot of nuances that go into that. You have to make sure the number is real as far as like the rental. You can't just charge yourself $1 million. It's got to be backed up by the market values. A second element is that people screw up on is they don't actually create a business purpose. So what we've done in our strategy is to create a monthly management meeting. So you get 12 of these a year because it's 12 months in the year, and we'll walk you through like how to actually look at your business as a business, because the biggest problem that small business people have is that they're not formally trained small business people. They are really good at what they do. Let's say you're an air conditioning technician and you become really good at being an air conditioning technician. You go out on your own and you say, I can run my own business being an air conditioning technician. And sure, you can. But what you're missing is all the managerial skills, even if it's just you, all the stuff you learn in business school and all that kind of stuff. What the summit strategy sessions do is it forces you to sit down once a month and go through your numbers and say, okay, here's how much money came in. Here's how much money went out. These are the different categories. Here's how it compares to last month and last quarter and last year. And how am I going to review what happened in the preceding time? And what does that mean for the future? And what are my plans for the future? How am I going to improve my marketing? How am I going to improve my cost structure? All these kinds of things. And what it does is it, one, creates a business purpose. Two, it creates a log for yourself. And three, it makes you run a better business. And all at the same time of that, you're actually getting a tax deduction because we've set it up right in the first place. So I would say those three are the three biggest. The third one, it could be a lot of things, but that's my particular favorite. So that is my answer with several it depends built in.
Understood, understood.
Yeah.
Thank you for that, Neil.